Welcome to the deep dive. Today we're getting into the Q3 2025 results for Block Inc. And we have to start with this headline paradox. Block shares, well, they plunged nearly 12% after hours, but the company actually raised its full-year guidance at the same time.
Yeah, that reaction is just pure market schizophrenia, isn't it? You got the immediate hit, that pain from the earnings miss. And it seems to be totally overshadowing the longer-term strengths management is talking about. So our mission today is really to unpack that disconnect, understand the market's fear versus, management's confidence looking ahead.
Okay, let's start with that fear then, because it was a pretty big miss right off the bat. For Q3, Block reported adjusted earnings per share of just 54 cents. That was way off the $1.63 analysts expected, like a 14% negative surprise.
Right. And it wasn't just EPS. The revenue side also disappointed. Came in at $6.11 billion. The expectation was what, $6.33 billion? So, yeah, missing by over 3% on the top line for a growth story like Block. Well, that immediately signals deceleration to investors. That's the trigger, That's what caused that big drop after the close. People wanted a clean beat, and, well, they get it.
Okay. So based purely on those headline numbers, the disappointment makes sense. But management pushed back, right? They talked about otherwise strong operational metrics. So if the earnings miss was that bad, what's the engine inside Block that justifies their optimism? What are they pointing to?
It really comes down to the underlying profitability. It's accelerating. If you look past the costs that maybe led to the EPS miss, the number Block is really hanging its hat on is gross profit. In Q3, gross profit jumped 18% year over year. That's $2.66 billion. And critically, that 18%, that's faster than the 14% growth they had last quarter. That momentum, that's the real story they want to tell. And it comes from both Cash App and Square.
Okay, Cash App, that's usually been the star performer, hasn't it?
Yeah.
What details show that acceleration is actually happening there?
Oh, absolutely. Cash App is definitely driving the bus here. Gross profit there grew 24% year over year. That's $1.62 billion. Still the main growth engine. They hit 58 million monthly active users in September, which is a huge number. But, what's maybe even more interesting is the quality of those users.
Right, not just how many, but how engaged are they? How much are they worth?
Precisely. Gross profit per monthly transacting active. They grew 25% year over year, hit $94. And if you connect the dots, that jump in value per user, it's mostly coming from selling them more things, especially the higher value products like lending.
Lending. And this is where the market gets a bit jumpy, right? We saw Cash App borrow their short-term loan product originations grew, 134% year over year. That is massive growth in credit exposure.
It is massive scaling, yeah. And it's a clear strategic move. They're trying to be more than just payments, a full consumer finance platform. The worry, of course, is always the risk. How much of that lending goes bad? Block says their risk loss is stable, still below their 3% target. And they're making really strong margins on borrow, like 24% annualized net margins. So for now, the profit seems to be winning out over the losses. But yeah, when you scale credit that fast, 134%, you are definitely increasing the company's underlying risk. And that tension, that's baked right into why the stock reacted so violently.
Okay, so Cash App's accelerating, fueled heavily by this big push into lending. But Block has two sides, right? What about the Square side, the seller side? Is that seeing the same kind of acceleration, or is it a different story there?
It's a bit different, more about climbing the ladder, maybe quality over just quantity. Square's gross profit grew slower, about 9% year over year, hitting $1.02 billion. But, and this is important, their gross payment volume, the GPV, that actually accelerated to 12% growth. The key is where that growth is coming from. They're successfully moving up market.
Moving up market. That's always been the goal for Square, hasn't it? Getting away from just the tiny merchants.
Exactly. And the numbers back it up this quarter. Look at GPV from sellers doing over $500,000 a year in volume. That grew 20% year over year. That's the best rate they've seen since early 2023. It shows they're landing bigger, more valuable businesses that are stickier, and more likely to use more of Square's other tools, not just payments.
And didn't they also call out specific areas like food and beverage? Saw good growth there, too.
That's right. 17% year-over-year growth in food and beverage GPV. So, yeah, specialization alongside moving up market. And don't forget international. That's another bright spot. International GPV grew 26% year over year. Shows their overseas push is working. Like Jack Dorsey said, they feel they gained profitable market share through product innovation and expanded distribution. That sums up the Square story.
Okay, so let's piece this together. The immediate Q3 numbers, especially EPS, were a shock, a miss. But underneath, management's saying, look, that miss happened because we're investing to fuel these engines. Cash App lending is booming, Square is getting bigger clients, which brings us to the forward guidance. This is their big counterargument, right?
Exactly. The raise guidance is a huge signal of their confidence. For the full year 2025, they're now calling for gross profit of $10.243 billion. That's over 15% growth year over year. And maybe even more importantly, adjusted operating income of $2.056 billion. That's nearly 28% growth year over year, landing them with a pretty impressive 20% margin.
Wow. Okay, so they must be expecting a really strong Q4 to lift the whole year like that.
They are. The Q4 outlook is even punchier. They expect gross profit growth to accelerate again up to 19% year over year, and they plan to hold that adjusted operating income margin steady at 20%. They also made a point of saying they expect to be approaching Rule of 40, specifically hitting 39.5% on their Rule of X metric. Okay, Rule of 40. For listeners maybe not deep in the sauce world, what does that actually mean? Why is 39.5% something that highlight?
Yeah, good question. The Rule of 40 is basically a quick health check for software and fintech companies. Simple idea, your revenue growth rate plus your profit margin should add up to 40% or more. So hitting 39.5%, well, it's management saying, look, we can deliver both strong growth and strong profitability together, portably. That balance is exactly what investors want to see, especially after an earnings miss. It signals future discipline.
Got it. That makes sense. So beyond just payment volume, what are the specific bets, the new things powering this optimism and justifying that 20% margin target?
It's really a few key areas. A lot focus on network effects and AI.
AI seems to be everywhere. How are they using it?
Well, Block's building it into the core experience. For sellers on Square, think of it like a virtual COO, AI helping manage the business. For Cash App users, maybe a virtual CFO helping with finances. Specific examples they gave were things like AI voice ordering for Square, or AI tools for procurement, things to make life easier and stickier. And the other big piece seems to be connecting the two sides, Square and Cash App, more tightly.
Yes, that's huge. Ecosystem connectivity, they call it. They launched this Neighborhoods on Cash App feature. The whole point is to drive those 58 million Cash App users directly to Square sellers. And they're offering big incentives like only a 1% processing rate for orders made through that feature in the app. It just makes the whole network denser, more valuable for everyone involved.
And then there's this proto thing, their Bitcoin mining business. Management's calling it the seed for their next major ecosystem. That sounds ambitious. Why Bitcoin mining?
It does sound a bit out there, maybe. But the thinking seems to be about building foundational infrastructure. It diversifies them beyond just transaction fees and crypto, lets them play across the whole Bitcoin value chain. It's a big bet, for sure. But combined with rolling out Square Bitcoin payments, letting sellers accept Bitcoin easily, it shows a deep commitment to crypto's future, well beyond just basic trading.
Okay, so stepping back, the big picture tension is Block missed earnings short term. Market punished it. But management immediately raised guidance, pointing to accelerating growth in key areas, Cash App lending, Square moving upmarket.
And underlining that, you have to remember that growth costs money. That's why they missed EPS. You see it right on the expense lines. Sales and marketing, up 17% year over year. They're spending to get that growth.
But the really eye-popping one is the risk loss expense line. Transaction, loan, consumer receivable losses, that jumped 89% year over year, 89%.
Yeah, that 89% spike. That's the direct cost of scaling Cash App Borrow so aggressively with its 134% origination growth. Block is clearly making a choice here. They're going for maximum growth, aiming for those future margin targets, that 20%, that near Rule of 40 number. And they're doing it by leaning hard into lending and spending big on marketing.
Which really brings us to the final question for you, the listener, thinking about all this. If Block is chasing this aggressive growth by massively scaling up its lending, which comes with more risk. How do you balance that? How do you weigh the shiny projected profitability, the near Rule of 40 status, against that increased operational risk? Especially, if the economy were to get tougher, their whole strategy right now hinges on keeping those lending margins high, like that 24% on borrow, while keeping losses below that 3% line, even as they keep hitting the accelerator. Something to think about.